Everyone, as we're diving into the DoubleLine commercial real estate ETF, I want to give everyone a little bit of background in terms of the commercial real estate debt market, just in totality. As we're thinking about the commercial DCRE, number one, we are trying to give investors access to the commercial real estate debt market through the lens of CMBS. As it relates to the CMBS market, in totality, it's about a third of the outstanding commercial real estate debt market. I think, as we're looking at the market in terms of size, something I was just going to point out, it's really 4.6 trillion in size. So, the real estate debt market in the U.S. is 4.6 trillion, of which 1/3 is comprised of commercial mortgage-backed securities. So it is a very notable market in terms of size, split between agency commercial mortgage-backed securities, as well as, private label non-agency CMBS. And from a fund and strategy perspective, we're here to give investors our best ideas, our curation of the, through an actively managed portfolio. Diving into the market, I know a lot of things have changed in terms of real estate fundamentals. I know there's been, over the last 24 months, a lot of news headlines surrounding commercial real estate, but I want to give everyone just an update in terms of what we're seeing, right? Number one, mortgage rates have been coming down, and this isn't just because of Fed cuts. I think it's in terms of Fed cutting the front end. This is also, generally speaking, a reflection of risk markets in terms of appetite for lending. In summary, across the credit curve in terms of commercial real estate, we're starting to see borrowing costs come down, and that to me is a positive as we're thinking about the commercial real estate market. Second point I'd like to make is there's an increase in debt availability, right? That kind of follows along the lines of why are mortgage rates coming down in terms of borrowing costs for borrowers. Debt availability in terms of willingness of lenders to come and step in and lend. Again, that is also starting to increase. And we came from a world where in 2023 we went through a mini regional banking crisis, and Ken kind of alluded to talking about bank failures such as Silicon Valley Bank. Well, we saw in the spring of 2023 where banks essentially, shut down, right? Lending essentially ceased for commercial real estate. And I would say that, in looking backwards as well in 2023, debt availability all but went away. That created a significant strain on the commercial real estate market, which is also why we saw a lot of negative headlines about defaults, about value declines in terms of buildings, not just office. We even saw value declines in apartments, but landing to where we are today in terms of transactions, we're starting to see green shoots. I kind of characterize everything as a normalization of the commercial real estate market. And so here, as we're kind of looking at the transaction activity, which is the gray line, in terms of what we're seeing in front of you, everyone right now, the gray line's actually bottomed out in 2023 and actually starting to tick up on a year-over-year basis. And similarly, on the lending side, lending standards have also eased just very, very slightly. So to me, these are green shoots. I think these are more, data points that points us to the fact that, commercial real estate, the stress on the commercial real estate market, while is there, we are, coming off of a base where valuations have largely bottomed, right? So the conclusion really is that, borrowing costs have come down in a meaningful manner. Lenders are coming back into the market to lend. Borrowers, are out there actively canvassing the market for deals. And the equation works itself out such that, valuations, will continue to normalize. I think the peak to trough drawdown on a national all property type index on a national scale was to the tune of around 12%. Quite surprising, just given in terms of a low number relative to some of the headlines. But the proofs and the details, as we're diving into each underlying asset class within the commercial real estate market. For example, apartments were down about 20% in terms of value. The retail sector, you can think about retail shopping centers and whatnot, they were down about peak to trough about 9.5%. Industrial assets, the outperformer, almost unchanged, about 90 basis points in terms of change in value downwards. And the underperformer really was office and continues to be office, for a variety of reasons, attributed to return to office, high interest rate environment, as well as just the generational shift in terms of use of office. But net, all of these blended together equates to value declines across the board for the commercial real estate market. So I'm kind of standing here and want to tell everyone that one, from a valuation standpoint in itself, the market has been through a lot. Values have been down, but debt availability has increased. Fundamentals continue to be fairly strong. And with that said, if we are an investor in this market looking at commercial real estate debt opportunities, I do think there continues to be very interesting and unique plays without having to go into equity. So zooming in, I look at the commercial mortgage-backed securities market in terms of the details. Here, you'll see annual issuance volume going all the way back from 2018 to 2024, with a 2025 being an estimate. If you just focus on the very, very right-hand side, you'll see that in 2024, issuance volume, so this is essentially newly created commercial mortgage-backed securities that are being sold to investors such as ourselves, money managers and insurance companies, as well as banks. Newly created CMBS, totaled around 100 billion in 2024. Compare and contrast that versus 2023, when it was only about 40 billion. And I would say that 40 billion was very front loaded, meaning it was essentially during the first quarter before the banks started having issues. And then, looking forward to 2025, issuance continues to increase. I think forecast-wise, this is just based on street forecast. I think JP Morgan put this data together. Their opinion is that issuance will be around 120 billion. I can tell you just from my own personal observation, the first month of January in terms of issuance was very, very strong. And these 120 to 140 billion dollar estimates in terms of issuance for 2025, to the extent that the market continues at this pace, will easily make these numbers. But what does this all mean? To me, this means that there continues to be a normalization of the commercial mortgage-backed securities market. This means that the existing CMBS transactions will continue to have on-time payoffs. It decreases extension risks. It decreases the potential for losses in terms of loss severities that investors were thinking about during the bottom of the market in 2023. And so all of these kind of port to the CMBS market being somewhat of a favorable environment, especially coming off of a base where asset values have declined so much. So I think fundamentally, as we're thinking about the commercial mortgage-backed securities market, investors are buying these bonds, assuming that the office buildings are going bad, assuming that there are declines in the multifamily space, assuming that there's all these stresses in the commercial real estate market. And in the CMBS world, as investors, we'll talk about loss-adjusted scenarios. When you're coming in thinking the worst, and the worst having not to come to fruition because the worst is actually a stressed scenario and things are actually better than you had thought, then that to me is a market where on a risk-adjusted basis, there's a lot of unique opportunities to be had, right? You can't. I can say that within most of the markets in the credit markets, there's only CMBS where you can go in and assume a lot of bad things happen and actually be able to make an investment based on that. And so, that to me, I think is what's unique that will continue, in my opinion. From a spread standpoint here, as everyone can see, we're still somewhat wide. If you just, kind of follow the left-hand side, here's a spread history, and it's somewhat skewed by 2020. You can see the scale of the 2020 move, but then you look at the 2023 moves in terms of spread widening across the capital structure. It was actually even worse for some of the tranches. And this was during the spring of 2023 when Silicon Valley Bank, as well as some of the other banks, were having issues. And so we came from a world where spreads gapped out in a meaningful manner to where spreads in 2024, as well as on a year-to-date basis, continue to grind tighter, right? There is a lot to be said about some of these wide spreads, and one can say, hey, Morris, I see 800 over on BBB minus spreads. What are the loss adjusted? What is a loss adjusted scenario just based on that? Because that can't just be the face value spread. And I can tell you that the market is pricing in losses and extensions. And if you factor in those losses, those spreads are probably closer to 400. And the same can be said about some of the other investment grade tranches where they're somewhat exposed to potential credit impairments. But with that all being said, spreads are still wide. There is a lot of optionality there, for an investor to be able to actively manage and dig in, understand each underlying collateral. You're able to really pick unique investments where more often than not, investors may oversee. So, talking about spread pickup and excess spread, on the very right hand side, you can see the cheapness of the market in terms of CMBS. And we're just using AAA, not the spicier stuff, but as we're kind of thinking about the AAA market relative to its historical history, and let's just compare it to the investment grade corporate market. Just at historical basis, going back 10 years, CMBS has traded inside, AAA CMBS has traded inside of corporates. Currently, CMBS is trading wide of corporates. We don't need to go through the reasons of why CMBS is trading wide, and we kind of explained that a little bit. But therein lies some of the relative value, to the extent that as an investor, you're able to pick and choose and pick apart some of these deals to extract this excess spread. So to me, there is a very compelling story behind why investors should be in commercial mortgage-backed securities relative to corporates. We continue to believe that there is excess spread to be harvested, and that's what this ETF is designed to do. Now, kind of diving in, we talked a little bit about the CMBS market. We talked a little bit about spreads in terms of the CMBS market, but zooming in, I want investors to kind of focus on certain areas of the CMBS market, particularly short duration CMBS. On the right hand side, you'll see that non-agency AAA CMBS, from a duration standpoint in itself, if you're just biased to be short, inherently, you don't have to give up a lot of spread to be shorter duration. And conversely, if you look at corporates, if you want to buy short duration corporate bonds, you do have to give up a lot of spread, and there's a premium associated with that relative to go shorter. So I think, net, from an investor standpoint, not only is our market cheap, but if you want to access our market through a short duration type of approach, which is, how DCRE is designed, you also don't have to give up a lot of spread. And that to me is very, very somewhat of a, very powerful sort of point that I like to make in terms of the CMBS market. So what are we doing in the fund? From a fund standpoint, and in terms of our ETF, we, in the beginning, as Scott kind of alluded to, we're biased to be short duration. I think inherently, when you're investing in commercial mortgage-backed securities, you should be biased to shorter duration. Two parts. One, because there continues to be seasoned deals to be purchased, and it always continues to be the most transparent areas of the market. And then number two, from a market creation standpoint, in terms of primary market, the CMBS market has also trended shorter, just given borrower demand for shorter duration loans. And so, as an investor, for us, this is, in our opinion, a very accurate expression and representation of the CMBS market. So short duration is number one. You're going to be getting a short duration portfolio. Number two, from a credit quality standpoint, we are focused on AAA rated to single A minus rated securities. Currently, the portfolio is predominantly AAA rated. The high quality sort of bias in terms of nature of the portfolio, lends to years of my experience navigating this market. I, for one, want to give investors access to the market, but in a safe way. And then number two, in also the most liquid way, liquidity in the CMBS market. At the top of the capital structure, you're getting the most liquid areas of the CMBS market. And from an access standpoint itself, again, it lends to in my opinion, one of the better representations of the CMBS market. So as you can see, over time, the fund, continues to perform very, very well. We are currently generating a yield to maturity of about 5.45%. Our 30-day SEC yield is around 5.5 as well. From a short duration standpoint, in terms of duration positioning, we're about 1.3 years. How do we sit versus other areas of the commercial real estate market, as well as the fixed income market? Here, this chart may look a little bit similar. Here, we kind of ranked our ETF in the grand scheme of things based on relative to other indices. As you can see, we, as a ETF, are able to deliver a high yield with a low interest rate sensitivity, just given that low duration bias. And as we're kind of looking through over the past 2 years, running this particular portfolio and strategy, just want investors to kind of focus on the blue line, which is our returns over the last 2 years, and compare and contrast that versus the 2-year Treasury yield, Treasury, as well as the Barclays Agg 1 to 3 year, which is our index. As you can see, through active management, from buying short duration CMBS, and it's not just buying blindly short duration CMBS, but picking and choosing specific securities, having a view on specific property types, having a view on those cash flows of the underlying buildings, and then layer on the short duration bias of the underlying portfolio, we're able to generate create essentially a portfolio with fairly smooth returns and limited volatility. As everyone can see, just based on experience. And over the last years, it's been very, very challenging in the CMBS market as well as commercial real estate market. But with that said, the point of active management is here, and we're appropriately staffed for it. Looking under the hood in terms of the bonds that we own, in terms of how the portfolio is currently set up, we talked about the bias, high quality nature of the portfolio. As you can see, 85% of the portfolio is rated AAA. We do have some AA's and single A's as well associated with specific positions that we like. But with from a concept perspective in itself, just want investors to take away that it's always going to be highest biased, high quality. From a property type standpoint, multifamily about 40%, retail about 14%, do have some office at 16%, lodging at 13%, industrial at 8%. But the point here is that it's a very, very diversified portfolio. We're buying a lot of these bonds that are backed by pools of underlying mortgage loans. Some may have 40 to 50 underlying loans in them. And putting together a portfolio is just based on that. So the nature of the diversification, to me, helps alleviate some of the idiosyncratic risks that's associated with this market. And I think the second point that we would make is that as we're putting together from a portfolio construction perspective, there are fixed rate bonds and there are also floating rate bonds. And so these are all different tools that we can pull in terms of lever to manage our portfolio in a way where it's durable across a cycle, right? In today's environment, just given some of the higher for longer sort of viewpoint in terms of rates, we do have a positioning for floating rate CMBS. So through the commercial real estate CLOs, which is about a quarter of the portfolio, we can get very, very good carry just based on that. On the fixed rate side, being inside of 3 years, you're also, getting exposure to the front end of the curve. To the extent that the curve falls in terms of rates, you also will benefit from that from a total return perspective. So at the end of the day, I'm here to, as well as the team is here to, put together a portfolio with diversification, with a short duration sort of bias and a high quality sort of specific bias. And it's has been thus far time tested. So, as we're, for those that aren't super familiar with CMBS, and I'll just kind of end, quickly in terms of, where we currently stand and, how a specific CMBS is made. Here, you'll have a asset, you'll see an apartment building, a loan is made on that apartment building. And, once that loan is made, this loan is in the blue part, it's about 65% loan to value. That loan is through the securitization process is then, tranched up into different slices of risk. DCRE is primarily focused on this light blue area of risk. So where we're rated, at 32% LTV, a AAA rated security implies a 32% loan to value. So that particular mortgage was sliced up or tranched up into multiple different tranches. We're buying the least riskiest, lowest leverage component of that specific mortgage. And when I talk about high quality, when we talking about ratings, this leverage, this loan to value, these numbers are typically in the 30s. So I think from a protection standpoint, in terms of losses in the event of a default, you do have ample amount of protection, especially given what we're currently investing in. And then looking to the portfolio, you'll see differing leverage points in terms of our exposure, as I kind of highlighted. From an average standpoint in itself, portfolio weighted average look through LTV just based on our holdings, it's about 34%. This is based on what we're currently buying today and what the portfolio owns. So when I say high quality in the real estate sense, your leverage exposure is very, very low. I think conversely, you can understand it as if every loan were to default, you would have to take a pretty significant, greater than 70% loss for your bond to take a first dollar loss. So it's very, very well insulated just based on what we're doing. And I think you can't do any of this type of investing, and you can't put this portfolio together without a team that is dedicated to the craft of looking at commercial real estate investments or commercial real estate debt investments. So from a process standpoint in itself, we dive through market fundamentals. We look at property level cash flows. We synthesize how does each underlying loan, how is that collateral applied to the bond structure? And so a lot of these things, whether it's making broker calls, understanding what tenants are in specific buildings, understanding the dynamics of travel and leisure in specific markets such as South Florida, these are all research and analysis that the team embarks on a day-to-day basis to invest in this. And this applies for this portfolio, also applies for something that is more riskier. So to me, with that said, I'm going to end it right here.